Welcome back, traders. We're here live with Chris Temple, the publisher of the National Investor, and Chris is going to give us his macro outlooks here for today. Chris, how you doing?
Well, real good, Dennis. Yourself?
Not too bad. We're just looking here at the S&P futures trading up here at new all-time highs here again. This market always, everybody says climbing the wall of worry. Well, this market just continues to climb here and just nothing seems to derail it. What are your overall thoughts here?
Well, it's climbing a skyscraper of worry. It seems. I quipped, off the air when you and I chatted a minute ago. This is like the Alfred E. Newman market, the old figure from Mad Magazine who used to say, "What, me worry?" Traders aren't worried about much of anything right now. No sooner have the voting booths started to cool off in Ukraine than the new president is launching offensives against a couple of those eastern Ukrainian provinces. There's been more deaths in the last few days there than there have been in the last month. Nobody cares about that. You had European election results over the weekend that at the very least are going to pretty much bring any legitimate form and anything that's going to help the markets long term to a standstill in Europe. Nobody cares about that. China sank a Vietnamese fishing boat, and they're alternately in spats with Japan and with Vietnam. Nobody cares about that. No one cares about China's economy arguably contracting. So we have a situation where, as your last guest said, it's really hard to fight the tape here. It doesn't matter what's in the news right now. What matters is that we may, as you just said, be about to break more convincingly after several aborted attempts to new all-time highs, and money managers have to chase that or lose their jobs.
Is that what this is? It's just chasing, you think it's just the investors and money managers chasing this market and they have no choice but to be in? Is that why we have this huge disconnect?
Well, I think to a great extent that's the case. I mean, it's a smaller version of what we had in 2013. But back then, I mean, the average money manager, whether you're a hedge fund, whether you're a mutual fund manager or whatnot, for the most part, their job is to keep up with the Joneses. They are benchmarked
Right.
against the markets and against their competitors. And most people, their managers, their bosses, even their shareholders, most of them don't want to hear any story of, well, I don't like what's going on in the world. I want to be cautious. I think it's good to be in cash right now. You do that too long and the market gets away from you, as it's happened in the last couple of years, you're going to be looking for a job someplace else. So that's a big part of it. And I think there continues to be, Dennis, this underlying complacency that investors have that the central banks just won't let things unravel. The interest rates are being further compressed. I think they're going to continue to go lower, long-term interest rates. It's interesting this morning, in fact, that at the same time that we're seeing the futures indicate, if we were to end the day here, close well above 1900 on the S&P 500 finally, that long-term rates still aren't moving up.
What do you think? What's going to change? Like, what's going to change that overall sentiment? Like, to basically, is anything going to change, or are we just going to continue to climb this wall or skyscraper?
Well, I think for the near term, the path of least resistance is still higher. I think that we're in a very broad topping process. As I spoke with Joel when I was on your program a couple of weeks back, the way I choose to approach this market now is, okay, you've got to participate somewhat. But let's look at individual stories. Let's look where there is value. And there's more out there than the average person realizes. You don't need to chase the momentum stocks higher. There's good bread and butter companies that pay solid dividends that you can be buying right now. And I believe most of them will do well, even if the market finally rolls over and we get this correction that everybody and his dog has been calling for.
Okay, so you're mentioning about there's still stocks out there to buy and paying good dividends, good risk reward ratio. The utilities kind of left the station a little bit early today. What are some of those stocks that are on your radar?
Well, I'll tell you one I like in the tech area, and there's a lot of overvalued tech stocks. There's a lot of undervalued tech stocks. One of the ones on my list, I don't own any of it. I'm not paid to shill for it, so I want to throw that in there. I like Nuance Communications. They're, of course, among other things, the inventor of the Siri software. Starting with the 2015 model year, your Chevrolet is your General Motors cars, most of them are going to have Siri embedded in it. So your car is going to be a traveling smartphone. They, I believe, at some point are going to be a takeover candidate. Carl Icahn still owns a big chunk of it. He's got his son and one other guy on the board. that stock has done lousy over the last couple of years. I mean, this was a company that you go back 2 or 3 years was trading in the low to mid 30s. It's half of that right now. And the biggest reason being is that they had an earnings hiccup in the last couple or 3 quarters because, as many software companies are doing, they went to a model where instead of selling their software and their technology on a one-time deal for a flat fee of that kind, they're selling essentially subscriptions. Microsoft is doing this with its platforms. A lot of software companies are doing this. So they've sacrificed a little bit in the near term for earnings for something that's going to be more predictable long term. I think if you look at the way that earnings are going to start to bounce back there, at under $16, it's a very attractive company. One of my big things is agriculture and land. I think that as the central banks continue to print money, as we go forward, you're going to start to see more of this bleed into some of the commodity areas, as it did in the 1970s when we had stagflation back then. I think you've got to be careful because a lot of the industrial metals are still going to be in some trouble because there's not a great deal of growth in the world. I like a little company. They are major landholders in Argentina and Brazil. It's called Adeco Agro. The symbol is AGRO.
AGRO.
They have enormous farming, energy, biofuels, food, big operations primarily in Brazil and Argentina, a growing part of the world. Whatever you think about the stock market, there's 7 billion hungry mouths to feed on the face of this earth. And I think that's that's one of those ones you can, I'm not a big buy and hold investor for the most part because things are so dicey. That's one that you can buy and stick away.
Does it pay a dividend?
That particular one does not. As far as dividend stocks, I think when you and I spoke last time, one that I love right now is Tidewater. It's got a little bit better than a 2% dividend. Major bread and butter oil service company, also being touted as a takeover candidate, and it's on a rapid earnings trajectory right now. I mean, they're looking at the possibility of as much as $5 in earnings per share in the next fiscal year. A $50 stock, that's a PE of 10, pretty darn cheap with a 2% dividend. A lot of upside in the share price.
Okay, so food and water and are some of the things that you got your eye on. How about some of the higher paying dividend stocks, some of the big cap stocks in the S&P 500? Your Johnson & Johnson has had an incredible run, trading over the $100 mark consistently. Procter & Gamble, I mean, do you see much growth for these companies? And, with the dividend, how do you approach them?
Well, most of those, I tend to focus more on story stocks. I don't get into a lot of the big cap stocks myself, but generally speaking, especially when I'm giving sector allocations and talking about, putting X percentage in the S&P 500 because I think the market's going to do well, I think those will be good market performers. I'll tell you a couple of things that people can be in is there's a lot of good ETFs that focus on dividend payers, even preferred stocks that would be good to be in right now. And I think all of them are going to continue to get some good attention because, as I said earlier, I don't see interest rates going back up anytime real soon. It's extraordinary. A lot of people have been scratching their heads trying to figure out why, instead of continuing to go up as they were at the end of 2013, we see rates going down. That's going to continue. And oddly enough, because in the U.S. here, we're actually, as goofy as it might sound, we're kind of a high-yield country right now. 10-year notes in Germany, 10-year boons are under 1.4%. Here, you're still getting 2.55. Japan, you get 59 basis points for 10 years.
Right.
And I don't see that changing right away. In fact, I think as we go forward, the entire world, for a while at least, is going to start looking more like Japan, where it's not going to be rates coming up so much in places like that where they're really in the basement, but rates in countries like the U.S. that will continue to flutter down. And that has to support dividend payers because money managers have to look for a return someplace. You can't take your money out, put it under the mattress. You've got to do something. And when you've got the Johnson & Johnson, the Procter & Gamble's, good telecom stock, CenturyLink is one of the ones on my recommended list, one of the big three telecom stocks with a dividend still near 6%. Its total return this year is over 20%. the money's going to continue to go into those places because there's really no place else to go.
You mentioned preferred stocks, and that's something we don't talk a lot about on the show. I've got my own. I'm a trader, but I also have an investment portfolio, and I have a lot of different preferred stocks, but I have the individual ones. Is there a good ETF, like a good preferred stock ETF that you look at there?
There is one that Barclays has. Forgive me for not recalling the symbol right off the top of my head, but Barclays has got a good one. I think there's several of them out there.
Yeah, there's quite a few. I know like the PFD is one, or PFO.
Yep.
Some of these things yield 6-7%, and they just keep paying the dividends and paying the dividends here. And when you're getting 7% in a 1 or 2% environment, that's pretty good.
Well, it is good. I mean, a lot of people are afraid of them, but some of the mortgage REITs, they're very leveraged, but Annaly is one of the ones. NLY is a symbol on my recommended list. They've done very well. They've got a dividend yield that's a bit above 10%. They've maintained that dividend in the last quarterly payout. The big risk for those type of things, though, if you're going to get into these leveraged companies that that own mortgage REITs and have derivatives on them, is if I end up being wrong on interest rates, we saw interest rates shoot back up, you'd be in trouble in places like that. But for the time being, with a very benign interest rate environment, let alone if they do go lower, the mortgage REITs are a very attractive area.
And that's what we saw happen when just in the beginning of 2013 on a lot of those mortgage REITs, when interest rate concerns were just starting up, that interest rates might go up, and you saw that NLY go from $17 down to $10 and
Yep.
through the course of the year. And you saw some of the other mortgage REITs do the same, and even some of the preferred stocks really got beat up with those interest rates concerned. Now a lot of these companies have come back as the interest rate concerns aren't as high as they used to be, but there is that concern. Obviously, if interest rates go up, these things get whacked.
Oh, no question. And especially with things like that, you've got to keep one foot near the exit door. A lot of traders use different strategies. You may want to use a stop loss. You may want to just set yourself a target and start to take profits after they run up. I mean, Annaly was under $10 for a while. It's now up near 12. And again, with still a 10% plus dividend yield. And for the near term, I think they're in good shape. There's several of them out there like that. But This, of course, is still based on my view for interest rates. A lot of people look at technicals. The 10-year note this morning is 255 when I looked a few minutes ago. And if you saw a close back above 260, you'd want to worry if momentum was starting to go in the other direction. But barring that, we had a monstrous rally in bonds. I mean, the 10-year note went all the way down to 247 or some such thing. We've had a little bit of a correction from that rally, but I think that the big move is still going to be down over the course of the rest of this year in interest rates, and that'll support a lot of these things we're talking about.
Okay, getting a question out of the chat room here on FTR. Is that a stock that you take a look at all?
Questar?
This is Corporate Frontier Communications, and the chat guy's asking.
FTR, I'm sorry.
Yeah, FTR, and they're asking because it's a 6.88% dividend, which is looks pretty awesome on paper here. Do you follow that company at all?
I look at it from time to time. When I was looking at these things, my belief was that of all of the major telecoms you could buy, and I mean Frontier is not quite in the major category. I think the best risk reward going forward, and where there is still some decent growth, is CenturyLink. CTL is a symbol on that.
Right.
I don't have a really strong opinion on Frontier right now. I think there's a little bit more risk involved in that.
Okay, going back to the whole interest rate thing and the mortgage companies. I mean, this is basically all tied to the housing market. But getting some mixed data out of the housing market, that's kind of like a forerunner of things to come. Are you taking a look at any of the housing stocks? They've had some decent pullbacks.
My attitude, my knee-jerk reaction, Joel, on that would be to follow Jeff Dunlop's advice and short them. The housing market is in real serious trouble. It's I think one of the more stark indications that there is a disconnect right now between Main Street and Wall Street. There have been enormous rallies in some parts of the country with real estate prices. But because of that, because mortgage rates are, a point higher, they're more or less than they were a year ago, and because of still fairly tight lending standards in some areas, millions of Americans have been priced right back out of the housing market again. And this is one of the reasons why I believe that we are going to see a continued soft interest rate environment. The Fed is trying to figure out what to do about that. I mean, we're going to have a European Central Bank meeting next week where more than likely they are going to introduce a negative deposit rate and put a little bit more pressure on banks over in the Eurozone countries to free up some of the gobs of money that they just have parked under their own respective mattresses and put it back to work in the economy. You better believe that Janet Yellen is burning the midnight oil trying to figure out how to do that here.
Soft interest rates for the foreseeable future here. This has been Chris Temple here, the publisher of the National Investor. Chris, thanks so much for your comments here. And obviously, interest rates, he's saying, may not go up here in the foreseeable future. Thank you, Chris.
All right. My pleasure, guys. Take care.